Actually, I don't think it's so much a surprise that it's happening. It's more like, why did it take so long? And I think a lot of it has to do with higher interest rates exposing the severity of the imbalances. And from a financial perspective, what we're witnessing right now is an unwind of the capital misallocations going back to 2008 and arguably all the way back to the fall of the Berlin Wall in 1989. And driving those misallocations, one was the GFC. The United States had the biggest stimulus, both monetary as well as fiscal, and it has all the plumbing to be able to accommodate that. And you can see that in, whether if it was in the banking sector, capital markets, all of it attracted that. The second factor was the Mag 7, and we're going to talk about defense in a second. But why doesn't Europe have a Mag 7? It had no military-industrial complex, because with that comes GPS, internet, AI, all of that are extensions of the military-industrial complex. And then the third one is we're unwinding the trade imbalances. What's the flip side of the trade imbalance? Capital inflows into the United States. And so what we're seeing is a rebalancing of global capital flows. And we think we're in the midst of a major capital rotation back towards Europe and towards the rest of the world that was going back to '08.
I mean, your defense spending prediction is massive. It's $14 trillion. Does the NATO spending actually help in making that a reality?
Well, 14, let me put this in perspective. The China boom, the BRICS boom in the 2000s was 10 trillion. Put it in today's dollars, like 15.8 trillion. So we're in that magnitude. Now, the 14 trillion is they do everything right.
Right.
The worst case scenario was 4 trillion, but even 4 trillion, that's a major capex boom cycle. And let's not forget, Europe really hasn't invested in defense going back for 75 years. So this is a big shift. And it's not, people, the macroeconomists say, oh, there's no cyclical benefit of defense spending. That's true from a demand perspective, but let's think about it from a supply perspective. I want to go back to why doesn't Europe have a Silicon Valley? Why was Silicon Valley called Silicon Valley? The U.S. military needed chips to go in the B-70 bomber and the Minuteman missiles that didn't melt. So having a defense spending or a military-industrial complex is a boom to productivity, technology. So there's a lot of side benefits. And one of the big benefits that we see at Carlyle is why was VC created and private equity created? To actually allocate that capital from the U.S. military-industrial complex. So this is huge. I like to say it's back to the future for private markets.
Jeff, so does this change everything with Europe, but in what time frame? Because it takes time. If you have any industrial plan and then a defense plan, it's time and to also find the technology and find the right investments.
Right, and I think let's go back to the BRICS boom of the 2000s. It took a decade to allocate that capital. Once you built the infrastructure to allocate that capital, then you overkill it, and you'll overkill it here as well. But I think the key point is this is not a flash in the pan. We're just beginning that process. And I've lived through 2 of these capital rotations. One in 02-03 when the capital left the Silicon Valley and went into the BRICS, and then another one in 14 and 15 when it left BRICS and went into Silicon Valley. So we're on another one of these right now. So.
Yeah, and you've been coming on the show and saying, look, we've been underinvested in so many key parts of the economy, including energy and security in general. What role can private capital actually play in helping Europe develop its military?
Well, you need an industrial policy to be able to funnel this capital into the right place. You can't trust something like defense to the vagaries of the public markets, and you don't want to put it all in the hands of a bureaucrat. That in between, the happy medium is the private capital, because it's a way to be able to maintain some type of control, but to make sure that you still get the balances associated with market pressures. So, that's the reason why the U.S. relied so heavily on it.
But the question is will Europe be as open, right, to PEs and VCs that the U.S. was?
Yeah, because trying to allocate it directly, particularly with the regulatory framework in Europe, is going to be really difficult. Right. And so, like Airbus is kind of a Lego approach to, doing aerospace. And doing that on a larger scale within Europe, across borders and everything, private capital is going to be the most efficient way to make that allocation of capital.
Do you have any specific projects that you think will kickstart, if those go well, then it will attract even more investment?
I want to emphasize, Carlyle has a long history in aerospace and defense. We've done 45 deals within the aerospace and defense sector. sector. At this point right now, is basically bringing in information, understanding what the space looks like. But Europe didn't completely get rid of its defense sectors. There's still a lot of mom and pop private held companies. Like France has a database that has over 1,000 companies that are dual purpose, commercial as well as defense. And so the opportunity in Europe is not as remote as I think people think. But I think it really starts with the private sector and these smaller type of companies that are more dual purpose.
We've also talked in the past about renewables. I mean, is it now, energy security that is the right word, but at the end of the day, will money and capital find the same deployment? Yeah,
energy security and, non-fossil fuels go hand in hand. I like to point out that France has the lowest carbon footprint of any industrialized nation in the world. And it did it in the 70s and 80s when it built all that nuclear capacity. And why did it build that nuclear capacity? Not because it wanted to save the climate, but rather because it wanted energy security. Another thing, take China. China has cutting-edge nuclear technology, solar, EVs. We know the list of what they can do. Why did they develop? They didn't develop it to save the climate. They did it for energy security reasons. And we think about fossil fuels. Why do we like them? They're portable and storable. But why are they dangerous? And as we witnessed with the potential shutdown of the Straits of Hormuz last week, it's because they're portable and storable. And the sun shines for everybody, the wind blows for everybody, and nuclear power is the size of your fist to power a city. You don't have that same risk that you have with fossil fuels. So I think the energy transition speeds up with this focus on security, doesn't slow down.
I mean, isn't it crazy, though, that we're just thinking of security, either energy or defense in 2025? We should have seen it like 5, 6, 10 years ago.
Yeah, but again, it goes back to that point. What has really changed here? I think a lot of it has to do with the 0% interest rate policies masked a lot of these imbalances. And now that interest rates are back up 4.5%, 5%, it starts to expose how serious these issues are and why they're hitting the burner today and they didn't do it 5, 10 years ago.
Well, what do you think will happen in the Middle East? I know there's been talk about a possible regime change in Iran, which then would unlock a lot of barrels.
I think the existential threat of Israel and Iran definitely is receding right now. I think that. But I think an important point here is the U.S. didn't even blink over concerns about the Straits of Hormuz. And it had to do with the fact that they're energy independent now. And that's a critical change. Again, why are these things happening today and they didn't happen 5, 10 years ago? 5 or 10 years ago, the U.S. would have been afraid to go into Iran because what if they did block the Straits of Hormuz? Now they're not dependent upon oil. And for Iran, you can't punch the guy that's hitting you if they don't feel any pain from it. And that's why the Straits of Hormuz weren't an issue for the U.S. and Iran didn't want to pull it. I think it goes to a broader point here. These energy security issues, the U.S. no longer has a concern to police global sea lanes to protect the oil trade because they're not dependent upon it anymore.
Yeah, but so what kind of, I mean, they still, if you think of the shale, in the U.S., they need a certain level, otherwise it just doesn't work. Yeah. So does it balance? Does it balance out if you go into strikes in Iran?
Well, I think the U.S. definitely needs prices above 65, 70, kind of basically where they are today. And you'll notice the administration went from 50 to 55, 60, and now it's 70. So they're kind of getting that message that you need to be in these levels. But I think people are very bearish because they believe there's this big surge of OPEC production. I want to emphasize, the 30 years I've been doing this, I've only seen 2 bear markets driven by supply. One in 14-15, another one in 1986. Producers don't shoot themselves in the foot, usually. And I think in this case, OPEC's going to be very data dependent, watch what's going on. And by the way, demand everywhere is surprising to the upside. In fact, I think we're on the position to see global synchronous growth for the first time in nearly a decade. Because you have the U.S. is actually looking much stronger right now. China's been surprising retail sales, exports, container traffic, and now Europe has released the debt brake on fiscal spending. We could actually see all 3 growing at the same time, and that kind of demand growth could accommodate that type of supply growth.
And this is against all expectations, is it?
Yeah.
I mean, despite the tariffs. So is it structurally that the economy is so different than we thought it was, or is it that it actually just focused the minds of politicians and CEOs?
I think that when we look at the environment was when you're in a phase with a high uncertainty, you do more spot, less term, meaning you're going to keep buying. And we saw this in 2018 when the last trade war, is that the hard data was very positive and the survey data was really negative. Survey data reflects how people feel. The hard data reflects what's actually happening. As they see the fear, they retract and go more to a spot basis, less on term, and you get that disparity. And as we saw, by the time you got into 19, that gap closed and the economy was doing well. Then COVID struck, obviously, but I think we're in a similar type of setup.
Jeff, I remember this iconic interview that you gave me like over 12 months ago. You said, we're running out of everything and no one's realizing, and you were talking like copper, lithium, and everything, rare earths that we need to help with the energy transition. Is there now investment back?
No, it's not. And I think you look at drilling in the U.S., it's off. Russia clearly hasn't been investing in oil. They've been fighting a war. Saudi Arabia is focused on Vision 2030. So there's 50% of the world's oil production. They're not focused on massive investment right now. And then you look at the rest of the world, they're not investing. By the time you get 26, 27, we have invested in refineries, drilling for oil capacity, and I don't want to get going on the other commodities. But I think when we look at the misallocation of capital, look at a ratio of equities to commodities or any financial market to commodities. You're just grinding lower and lower. This is going to reverse. I'm very confident in that view. Obviously, the timing, I think we go back to that view. It worked initially into 22 and early 23, but why did it stop? I think one of the reasons it stopped is the prices went too high, too quick, created a marginal increase in supply. Interest rates went up because of the inflationary pressures, and that slowed down particularly the property sector in China. And now we're rebalancing. That story we talked about in 21 and 20, it's still there. The question is what kind of demand growth will expose it? And maybe we see that this year.